Welcome to our complete 2-minute masterclass on HMRC Capital Gains Tax rules. With the April 5th tax deadline approaching, it is critical to optimise your investments. Every UK investor gets a £3,000 tax-free allowance. If you don't use it by April 5th, you lose it. Let's meet John. John has a portfolio consisting of the S&P 500, gold and Apple stock. First, HMRC matching rules. If John buys 100 shares of the S&P 500 in January 2020 at £10 and another 100 shares in February 2022 at £20, HMRC places all these identical shares into a Section 104 pool. His average cost is now £15 per share. Now, the 30-day bed and breakfasting trap. Let's say it's March 15th, 2026. John's S&P 500 has grown, and he wants to harvest exactly £3,000 in tax-free profit. He sells his shares. But 5 days later, on March 20th, he panics and buys the exact same S&P 500 shares back. Because he repurchased within 30 days, HMRC's 30-day rule triggers. His sale is matched against his new purchase, cancelling his £3,000 gain entirely. His tax-free allowance goes to waste. So what are John's strategies? Strategy 1. Bed and ISA. Let's rewind. John sells his S&P 500 on March 15th. This time, on March 20th, he repurchases the shares inside his Stocks and Shares ISA. The 30-day rule does not apply to ISA wrappers. He successfully locks in the £3,000 tax-free gain, and the shares are protected forever. Strategy 2. Highly correlated proxy assets. What if John wants to harvest a gain on gold, but his ISA is already maxed out? If he sells his physical gold ETF, like SGLN, and buys the same SGLN back, he falls into the 30-day trap. Instead, John sells SGLN and immediately buys a different gold ETF, like IGLN. Same tracking, same performance, but to HMRC, these are completely different assets. The same works for the S&P 500. Sell Vanguard's VUSA and buy iShares CSPX. Or for NASDAQ, sell EQQQ, buy CNDX. The 30-day rule is completely averted. Strategy 3. Spousal Transfers. John transfers some of his highly appreciated Apple stock to his wife. This transfer triggers no gain or loss. They can now both sell Apple stock, utilising two £3,000 allowances for a total of £6,000 tax-free. Strategy 4. Harvest capital losses. John reviews his portfolio and finds some tech stocks that are down. By selling these underwater positions, he generates a capital loss which can directly offset his other gains, shrinking his tax bill. Take control of your portfolio before April 5th. Use these strategies and visit cgtaxtool.co for detailed calculations.